Second module, why cash flowing real estate? So 4 ways we look at this, making money in real estate. First, you get the equity buildup with the mortgage pay down by your tenants paying rent. And this is the real big one, big difference between you paying down your rent with your heart, sweat, and tears versus your tenants doing it for you. It's almost like an extra income source. Number two, the tax benefits via depreciation from PALs, which is passive activity losses. Third is the appreciation from the property. And since you're able to leverage, you can buy many of them. And lastly, the fourth way, cash flow with rent to value ratios. These days, it's hard to hit anything under 1% in single family homes, but with commercial properties, there's a lot of better numbers. And especially when you add in other income, such as a lot of the apartments are able to charge for things like trash valet, late fees, vending machines. When you add all these up, it comes out to quite a bit. And we're going to be digging into each of those. There's an acronym out there, IDEAL. Each of those stand for one of these 4 things. But the way I look at it, I'm a numbers driven guy. The numbers just, when you add up all these 4 different ways you make money with real estate, that's what you compare traditional investment. So we'll break down each of those. First one is that equity buildup. PITI is the principal, interest, taxes, and insurance. As you go through the maturity of the loan in residential real estate, that's 30 years, usually amortized. In the very beginning, a very small portion of your monthly payments, your PITI, goes to your mortgage pay down. That said, as you go through the amortization period, more and more of your monthly mortgage checks goes to building up equity, essentially going right to you. Now, still locked up in the property until you sell it, but at that point, it goes on your balance sheet and it's equity going to you in the long term. And again, this is paid by the tenants, not you. Tax benefits here. So this is a tax form that you're seeing on this slide from 2019 and 2018. So in 2019, I paid 0% tax. 2018, I paid 4.2% tax. $3,700 over my AGI was $136,000 that year. And this is all with real estate. So with real estate, you're able to write off an asset, drive tax to the negative, and lower your adjusted gross income. We're going to be getting more into this in a future module. Some of you guys might be looking at taking money out of your 401ks or IRAs, but this is just a real high level. If you notice, I structured the first 2 right there. A lot of people say, well, yeah, owning real estate is a great way to write off the mortgage. Your interest payments is what they're specifically talking about. And they're correct, but we want more, right? We want a lot more write-offs and tax benefits. And that was something I never really understood. Like, why would you want to pay $10 in interest to get $2, $3 in tax deductions by paying interest? But hey, again, this is what's all stuck in the mainstream mindset, right? Regular financial ideas that we just all got it stuck in our head. People putting money into 4Ks and Roths. For most people who make less than $400,000, $500,000, it doesn't make sense to put money into these types of retirement plans, because when you put your money into one of these retirement plans and invest from it, you don't get these tax benefits that we're talking about here, namely the passive activity loss. So again, I think I'll highlight this throughout the presentation, but there are a lot of bad financial advice out there that has become dogma over the decades. This is why we always tell people, we'll get around our community, get around our group, come to one event and test drive it, or just join our family office Ohana Mastermind with well over 100 investors in there now, and get around a group of people thinking for themselves. Another one, buying a house to live in. Most times in normal financial speak, they say that's a good idea. And yeah, I would agree. Most people are really horrible with their money and they need a forced piggy bank. They need to be paying down a mortgage, because if not, they'll take that $1,000, $2,000 a month and go blow it on something they shouldn't. But a lot of you guys who are financially minded and have better incomes should probably pay offense more. And at least speaking to the younger folks out there in their 20s and 30s, it may make sense to forego buying that primary residence to live and invest first. Speaking from experience, that's what I did in my 20s. That's what really set me up. I didn't buy a house to live in. I just rent and actually still do this to this day. Hawaii is very expensive. It's $1 million to buy any type of house out here. So that's going to require me to take a $250,000 as a down payment. I'd rather have that be working in 4 or 5 deals in syndications and be leveraged there too. But like I mentioned there, I made a lot of these mistakes myself. After graduating college in 2007, I saved about 80 grand to buy this property right here in North Seattle, a neighborhood called Maple Leaf. And I bought it around 2009. Up on the upper right-hand corner is how it appreciated over the years. And this is what's nice about real estate. It goes up most of the time. And we say, do not focus on this appreciation portion. I always say it's icing on the cake, but it does, you're getting this appreciation leverage. So if real estate goes up by 2% and your leverage 20% or 1 to 5, you essentially get 5 times as much return. So instead of 2%, 10% there. Some people play this game where they just buy houses to live in, or they buy little rental properties and they appreciate it. I think it's a great strategy, but there's something later that we'll get into, forced appreciation, which is a much more reliable way of benefiting from residential real estate. The next one I'll highlight is cash flow. This is how you replace today's ordinary income. This was my goal when I first started to invest from 2009 to 2015 to 16, about there. After that, I had a little bit of shift of mindset, which I'll go over in a little bit. But throughout that time, I wanted to just get in all these rental properties and all these syndicated deals like how I have here. This was like a little mind map I put together of all my investments at the time on different ranges from Class A to Class C, more yield plays, more heavy reposition. This is not scientific. This is not anything I think anybody should try to emulate, but it's something that I was very focused on in replacing my income. Later, what I discovered as I started to meet more higher end investors, this for me around 2016, 17, 18, was that the more and more people have money, when you start to get to 3, 4, 5 million plus net worth, a lot of these people, they don't really care about their cash flow or income. Again, this is going to be important for a lot of you folks listening, as it was for me. It's going to be on the forefront. The reason being, you probably want to leave your day job at some point or not want to be forced to be there forever. So you're going to be trying to build your portfolio with an emphasis on cash flow. In reality, you should be really focusing more on equity growth, which tends to forego cash flow in the interim. Again, what I try to do is emulate what higher net worth, more experienced investors do. And what I've discovered is they tend to not really care what cash flow comes in on a month-to-month basis or quarter-to-quarter, and they focus more on the big picture, their net worth growing. And you might say, how do they pay the bills? They either have a job that they enjoy at that point because they're probably working for the fun of it, or they have other investments in their portfolio that are already kicking off cash flow at that point, or they have the financial means to have hundreds of thousands of dollars in their infinite banking, and they can pull from that if they need, or they just have money in the bank, literally. I think at the end of the day, real estate is what got me to the dance. When I graduated college in 2007 and in 2009, got my first rental, my portfolio looked very much like the traditional investment portfolio, where we'll define it right here. Real estate is considered an alternative investment, whereas stocks, bonds, mutual fund, money market, and cash are considered traditional investments. We like alternative investments, at least to get started, until you've hit $3-4 million net worth, because slightly higher returns and the tax benefits that we mentioned earlier. But here's a little chart just to compare different asset classes. The real estate tends to have a little bit better returns, especially when you're using leverage. You're having equity build up there. It's a hard asset as comparison to these others, better tax benefits. The only downside about real estate when you compare it with these other asset classes, liquidity. Once you're in, you're stuck in it. But I would argue, like, where else are you going to have your money working harder for you or getting a higher yield that you got to wait for? Especially when you get into projects that are value add, they're going to have higher returns, but this component of illiquidity is much more present there because you can't just take the bread out of the oven halfway and pop it out. I had an investor, he was not one of my investors, it was one of these investors from one of these silly forums out there. They said, I don't like these private equity or real estate deals because it's like a boomerang. Like a boomerang, you throw it and you got to wait till it comes back. And you don't really have control when it comes back. And a lot of the unsophisticated investors were like, yeah, that sucked. I don't want to wait. But a lot of more experienced investors who've gone through this say, yeah, man, that's how investing works. Especially when you're doing some type of value add business plan. This thing isn't going to be overnight. Wealth did not come to those who are impatient. So with that in mind, that's the downside of real estate. But if you're in it for the long haul and look, a lot of this is not the get rich quick scheme. The other one that we don't have on here is private equity and investing in businesses, which we're starting to do as a group. Now you're getting into much higher returns and more asymmetric type of plays. But the reason why I try and keep it simple here is a lot of the people that are going through this masterclass might be under a couple $1 million net worth. And if you're going by the rubric that I have in my book, The Wealth Elevator, there's a little pull-out chart. And if you are keen enough to look at the asset allocation mix in that chart for folks in the first floor and the basement level of the Wealth Elevator, you're seeing a higher concentration of alternative investments versus traditional investments, stocks, bonds, mutual funds, a lot of the typical financial planner brokered stuff. Now, I try to speak from experience. When I first got started, I had a traditional investment portfolio, wasn't really getting anywhere, was on the 30, 40-year plan. But then I bought a rental property and I was like, wow, this is great. This is a lot of beer money. I need to keep doing this over and over again. Eventually, I had 11 rentals in 2015. And by then, I had just pulled my 401ks and IRAs. I got rid of all that stuff in the Roth. I realized it just wasn't for me. And I needed to use that precious down payment cash to buy more and more rental properties. At that time, I probably had 90 something percent of my net worth in alternative assets, and it worked for me. So I know not everybody's going to be as crazy as I was in my 20s, applying all my money into alternative investments. That said, the Wealth Elevator pullout chart has a little bit more of a mild application of what I personally did. Now, if you're somebody under $1.5 million net worth, you may feel really uncomfortable going over 60% alternatives, even though that may be what you should do. But certainly, I think you need to get above 10, 20%. So everybody's going to have their level of buy-in on this type of stuff. And I'm not such a person to say you must do 46.7% alternative investments. I don't know how you would get that or measure that really. But I think what I'm looking for everybody is like, hey, just incorporate a little bit of real estate, value add, private equity into your portfolio, try it out, and then increase over the years. Sure, that's going to take a lot longer than if you prudently stepped up to 20, 30% and then increase from there as deals started to cash out. But I think we're going after baby steps here because I get it. For a lot of folks out there, this is totally brand new, investing off the beaten path, off of what all your friends, family, coworkers are doing out there in the traditional investments. But when you add up all these ways you make money with real estate, you're making, when I calculated on a whiteboard exercise, about 30%. But that didn't include the bonus here at the end, which is the value add force appreciation portion.